Hello, this is Miles Tullo bringing you the JD Power Financial Services Intelligence Update for March 2025. This month, I'm joined by Jennifer White to discuss our latest findings from the U.S. Retail Banking Satisfaction Study. Welcome back, Jennifer.
Hi, Miles. Happy to be here.
Always great to have you. So let's get right into it. What stands out most about the results this year?
The Retail Banking Satisfaction Study is our annual release of our flagship study in our banking practice. And what we see in this year's data is quite interesting. One of the first things I want to call out is that we all know that things are feeling a little hard for consumers these days, and we're seeing it play out in the data. The average amount of deposits that customers have at the bank is declining. Their total investment dollar amounts are declining. The problems that they're having, the friction points that they might be having are increasing with their banks. The need to reach out and solve some issues are increasing. But on the flip of that, what we see is that consumers are telling us that their satisfaction with banks is increasing. Their likelihood to reuse a bank for that next new product that they need to get is increasing. NPS scores are up. If we ask questions around consumers' personal financial outlook, this data was collected through January of 2025, and all of those metrics were positive. So we have a juxtaposition occurring. Things are hard times, but satisfaction with our banks as partners to help us navigate those times is improving.
Wow. Yeah, that doesn't happen normally. When people are
Yep.
struggling financially, we seem to see satisfaction come down, right? What do you think is going on?
Well, I think banks are rising to the challenge. They were prepared for challenging times in many ways. Our bank partners have invested time and money and resources into making things like problem resolution just a little easier to achieve. They've spent a considerable amount of time helping customers understand, navigate, and avoid fees. They're spending time helping customers manage their financial lives in a way that goes well beyond routine transactions. If you've logged into your bank's mobile app recently, it's a lot more than check deposit and transferring money. You have the ability to set budgets, create savings goals, and do other things that help you feel empowered to navigate the financial circumstances that are around you.
That's great to hear. You mentioned fees. You've talked in the past about the three F's: fees, fairness, and fraud. How are the banks doing on those fronts?
Consumer worry, whatever word we want to associate it with it, anxiety, worry, stress over those three F's remains at an all-time high. Consumers' ability to avoid fees, to feel that they're being treated fairly, and protect themselves from fraud is paramount. It is a deal breaker for trust. It is one of the reasons that a consumer might say, that's it, I've had enough. I'm going to leave this bank and go to another one. Banks are taking incremental steps to help make each of those things easier. Have we gotten to a place where they are no longer some of the biggest concerns for consumers? No, we're not there yet. But many banks are taking baby steps to helping consumers just feel better equipped.
Got it. Let's pivot to deposits. Last year, we saw a decline in average deposits, partially driven by economy, partially driven by consumers opening accounts with and diversifying their portfolios. Has that trend continued?
It has continued. I think we're facing what we see very often in the greater macroeconomic state, which is this division between those who have a fair amount of deposits to place anywhere and those who just don't have enough. And in the current data set, 33% of consumers tell us that, with their primary bank partner, they have less than $1,000 in deposits. If I go to that $2,000 level, it's 51%. Half of consumers today are struggling to have large portions of deposits with their primary bank partner. Now, you might say to me, oh, well, maybe they have money sitting in a high yield account somewhere. That's true. It's possible. But I suspect that somewhere in that 49% that I was just saying, the opposite of the 51, they're the ones that have the money over in the HYA. And we're just seeing that there's a large portion of U.S. consumers that don't have that emergency savings fund available to them.
Got it. Which comes to advice, it wouldn't be a complete conversation with Jennifer White without a discussion about financial health and advice. How are the banks doing on the advice front?
One of the things we should be happy about in the banking industry is that consumer recall of the efforts that have been put into advice and guidance provision is increasing over time. And so we see that we're getting consumers' attention at a much higher rate than we have in the past. We also see in the data that consumers are converting to action in pretty high rates. So if we think of advice as a funnel, the leak still really is occurring at just getting customers' attention. And, that at the core is about volume of messaging, the spread of the messaging over a calendar year. It's about making sure that the content is personalized. All of that comes into play, and it has to come through all channels. It has to be something that's a personal service experience. If it's a teller or a call center agent, happens within the digital engagement, at a minimum, banners within the mobile app, right? Or perhaps tools that push information, and then marketing that combines to help bring those messages home.
Always fascinating speaking with you, Jennifer. I really appreciate your time today. Thanks for joining us.
Thank you. Take care.
All right. So the J.D. Power U.S. Retail Banking Satisfaction Study is available now. You can learn more about it in the press release link below. I'll be back in April to discuss findings from our investor satisfaction study. We'll see you then.